Good afternoon, everybody, and welcome to our next edition of, oops, excuse me, let me move that out of the way there for you. Correspondent lender training. Today we have a new guest for us, Jonathan Barney from our processing team. Also on the call, you'll be familiar with myself, Chris Dorin, Vice President of Sales, and Jacob Therrien of Bridge Loan Network. Today our focus is really going to be on a couple of different things. We're going to talk a little bit about the processing of the loan as far as what the requirements are and some of the trouble areas that we see. So Jay's going to go through that with you guys. Jacob's going to show you some of that, where that stuff's going to wind up within Bridge Loan Network itself. And then in the latter half of the presentation today, we're also going to touch on the correspondent lender guidelines that were sent out earlier this week that you guys should have access to. If you don't, we can certainly send those out to you via email for some reason if you didn't get those. But to start off, I want to kick it over to Jay. Jay's been a processor with RCN for a long time. He's one of our senior guys, and he closes more loans than probably everybody else in the processing department every month. So welcome, Jay, to the presentation.
Thank you, Chris. I appreciate it. Are we ready with the slides as well?
We are, yes, sir. We will kick it over.
Let me know when that's up and running now.
Yep. Let's see here. There you go.
All right, perfect. So I'm just touching on, firstly, homeowners insurance, and this is specifically regarding 30-year loan, because I'm going to touch on the rent loss coverage. And there's really four main points that I'm going to hit. First one is pretty straightforward with the name insured. The name insured has to be the LLC, or the additional name insured has to be the LLC. We can do both of those. It really doesn't matter, just as long as it's clear for us. Second point I just wanted to touch on was dwelling coverage. Dwelling coverage has to be at or above our loan amount on the actual file. We can do it under the loan amount if we have the replacement cost estimator as well. So what I would do is, while you're requesting the HOI from the agent, is just go ahead and request the replacement cost estimator while you're at it. Essentially, it's their calculations of how much it would cost to rebuild the property. If you're getting that up front, that can just alleviate some delays in the process as well. So if you're getting the policy and speaking directly to the agent, it's a good idea to ask for that as well. Another one, it sounds kind of straight up, especially if this is a State Farm policy, but the loss of rent coverage on here, coverage C, State Farm is actual loss sustained. So that's perfect for us. What we need is at least 6 months of rent loss coverage, which is clear on this policy. There's 12 months. And actual loss sustained will cover our guidelines for that. If it's not actual loss sustained, we need to go with the greater of the two. So either a lease, if we have a lease, because sometimes purchases we won't have it, but obviously on a refinance we will, or the market rent going off the appraisal. So whichever one is higher, that's what we're going to do. We're going to multiply that number by 6, and then our rent loss coverage has to be above that in proof that it's being shown for 6 months of coverage. Sometimes I'll get declarations policies that just have loss of rent, and it just says included. So if it does that, you need to push back on the HOI agent or the borrower and just say you have to get confirmation on a policy of what it's actually going to cover. If we don't have that number, we're not able to get a rate block for the file or send it to underwriting without knowing exactly what we're covered there. Next portion, and it seems pretty straight up, but is just having the policy premium on a declarations page. I'll get evidence of insurances that an agent will make up that doesn't have a premium on the policy. So it's just double checking to make sure it's there. With refinances as well, please get in the habit of asking for an invoice which has the remaining balance on the actual premium. That way we're just being a little bit proactive. We know exactly how much we're putting on the HUD at closing. And then really the last section of the HOI here is just the mortgage E-clause. Just double checking to make sure that that's correct. There's so many times where, maybe that's the last condition for a clear to close. And that mortgage E-clause comes to us wrong, where there's, the ISAOA / ATIMA is missing, or it's a different address on there. Some HOI companies, for whatever reason, their mortgage E-clauses auto-populate. So they're just taking that and inserting it right into the policy when it's not correct. So the importance of just double checking all of these before you're sending them over, especially when, it's a last condition and the condition is just getting the mortgage E-clause changed. So the importance of checking that is, let's say you send it over to me and, I'm in the middle of reviewing the file and sending a different file to underwriting. So, you send this policy over to me. I don't see it in my email for, 20 minutes while I'm in the middle of submitting a file. Within those 20 minutes, two, important emails came over that I had to get to first. And then essentially I'm not reviewing this HOI 40 minutes until, since you've sent it over to me and the mortgage E-clause is wrong. So then I send it back to you, letting you know, hey, we need this corrected. Maybe at that time you're in the middle of a call and you're busy. You don't see that for another half hour, and then you send it over to the agent. So, right there, we're losing an hour plus until the agent can make the change. Whereas if the agent is sending the policy directly to you, you're looking at it and you have the chance to look at it immediately. You're immediately seeing that it's wrong and then just pushing back on that agent. So just a tiny little mistake and just making sure that we're a little bit more diligent on the front end of these, can cut off an hour, 2 hours, whatever it might be. And those are really my main points that we need to look at on every HOI policy. I think the biggest one that I see is the loss of rent coverage and policies not specifying that of what it actually covers. It might just say included. And again, we need to know, what's included, how much, and for how long. Unless it does say actual loss sustained, then we're going to be okay there. And the verbiage on some of their policies, some different insurance policies might be different. It might be loss of use. It might be business income. All of that, acceptable to us. It's just really comes down to the coverage. So those are going to be the big takeaways on the HOIs that you really should be looking for.
Hey, Jay, what would you say is the appropriate timeline for, when the correspondent lender should really be pushing and asking for the insurance policy? Because I've seen some people will send it, way up front, and that's before we have the appraisal, but, numbers could still change at that point.
Yeah, definitely. So, if they have an active policy, I would advise them and see if you can get it essentially as soon as you can. I wouldn't have them make those changes up front to the mortgage E-clause before we get the appraisal back, because there's plenty of times that we're doing a cash out refinance and the value doesn't come in at, what we were expecting, what everybody was expecting, and the deal's essentially done. So you don't want to have them, changing policy mortgage E-clauses before, we're closed or before we're ready to close. So I would try to get it up front, but if not, once we're getting the rate locked, you're confirming pricing with your LO, they think the deal's good, client's happy with the pricing they're getting, then I would go ahead and ask them to change. On a 12-month, we don't need it before underwriting. So the 12 months are okay that we're getting conditioned for every single time. But when we're making changes to the policy, I would say that's, right around the underwriting time where everybody thinks we're moving forward with this and we're good to go. or, after the file has been approved as well.
Yeah, thank you. That's a great point that you make there too about the bridge loans being different, because the 30 years we need to know what the final insurance policy and premium are going to be so that we can lock in the taxes and insurance figures for the escrow. Otherwise, we might have to, if something changes, and some of you guys may have seen this before, where a borrower gets an update to their insurance after we've already gone to the approval process. Next thing you know, we then have to go back, relock that pricing at the updated policy premium amount, and that can cause some delays and things like that there. So I think you're pointing out, that once we have the appraisal back and we've kind of requoted those numbers, that's the ideal time to really lock in that insurance policy for us so that we can be confident in our rate lock and also get that file moved over to a final underwriting stage. But to your point, if it's a cash out refi and they already have an existing policy there, and it already has the existing coverages that we need, and the borrower is not going to reduce their coverages based on a certain appraised value, things like that, we've certainly been able to move forward with those, and we can still get the rate lock even if it doesn't have the mortgagee clause quite correct. That's not going to hold us up. The things that really will hold us up is if the dwelling coverage or the rent loss are insufficient, or if we're missing a policy premium, or say you have a policy that's about to expire within the next 30 days. Those would be things that could be problematic for us and that we would want to get addressed on the front end there. I want to point out to the members of the audience as well, using the GoToMeeting toolbar there is a space for you guys to go ahead and ask questions in the chat box. So we will take questions certainly as we go. We will stop and make some time for that as well. But some of the questions might be answered later in the presentation as well, just to kind of keep some things going. But Jay, if you're ready, I'll switch to the next slide.
Yeah, just one more quick thing too, and I guess you could switch because it's not really about this policy, but one thing too is, especially on 30-year purchases, we still need a number to rate lock, and we can use a quote to get a rate lock as well, as long as it has the dwelling coverage and rent loss coverage and premium there, we're okay. But keep in mind that we are locking that rate off of the premium on that quote. So 3, 4, 5 days later, when they're ready to bind that policy, just try to ensure that that premium has remained the same, and kind of set those expectations up front, saying, hey, if this is the quote, is it valid for 30 days? Is this the one that we're definitely moving forward with? Because there's times that we use a quote, goes through the underwriting process, it gets approved, and then we get a declarations page with a different premium. And then the LO has to go back, get a rate lock again using the different premium. And essentially, we're hoping that, there's no significant difference in the premium where it changes terms.
Mm-hmm. Is there a difference for you as a processor if it's paid in full ahead of time and you get a receipt, or if you get an invoice and pay it on the HUD? Does that matter to you?
No, it doesn't matter to me at all, just as long as we kind of know up front. So that's kind of the importance too on the refinances is when you're asking for these changes, just make sure you're asking up front for, an invoice that shows the remaining premium. Because a lot of times I'll get, the changed policy for a refinance, but it doesn't come with, the invoice. That's certainly not going to, hold me up from submitting a file to underwriting. So I'm going to move forward with it. But my goal is to make the underwriting conditions as little as possible. So just trying to do as much work on the front end as we can, so that immediately after underwriting, it gets a quick approval and we get the commitment assignment out, as quick as possible.
Absolutely. Thank you, sir.
No problem. We can go on to this next slide as well. So really there was, the 3 topics I wanted to cover were the HOI, assets, and then just a little bit of the loan setup and just kind of, some document collection techniques. So just first off there, any retirement account, we're only taking 50% of that account balance. So keep that in mind. I'll skip to the third point there, but ending asset statements must be within 45 days of closing. So, right now I have a lot of quarterly 401k accounts that, were last produced on 3/31. So by the end of this week, they're all expired. What we would need is a corresponding screenshot that would have, the account number, or at least the last four, and then something showing that balance, as well as the current date whenever they're taking that screenshot, and then we're okay to using that. But if we're ever using a screenshot or a transaction history from a bank statement, we always need a full official statement, whether it's, a monthly bank account or the quarterly 401k account. I also say ask for all asset statements as well, whether it's personal or business account, or maybe they have multiple entities that they use and they have a bank account for each entity. The only thing we would need to get with that as well is a corresponding operating agreement. So if we're closing in 123 Main Street LLC, but they have a bank account with ABC LLC, we need to get that operating agreement as well, just to essentially prove that they own that bank account and have access to it. Asking for all bank statements, let's just say we're doing a purchase and we need 50,000 for, the sizer states we need 50,000. That sizer isn't 100% accurate, just because at that point in time, we don't know all of the fees that the title company is going to be charging. We don't know at that point how many months of taxes are being escrowed based on what's been paid. So asking for all of their bank account statements, all it does is strengthen the file. So if a file is going into our credit committee and it's maybe a borrower with, minimal experience and not great credit, and, just frankly, maybe it's not a great property, but, it still gets by, assets and having significantly over what's required is the biggest compensating factor you can ask for. So, if we say we need 50K, let's at least try to get a little bit of buffer on there. And that's kind of how you can explain to the clients is, hey, the more assets that you're going to show here, the stronger your file is going to be, the easier, the smoother it's going to be on the back end of this transaction. And if there's somebody that's doing quite a few loans, just get in the habit of asking them every month to provide new bank statement, new asset statement. As soon as they have an available full statement, they're easy to get. Most people have them on their online banking. Should only take them, a couple minutes to get to you. So if they're going to be in your pipeline for a while, just kind of set that expectation up front that you're going to need bank statements every month. So we're just not running into any issues. We're not running into last minute bank statements expiring because the file was kind of sitting and clear to close for, whatever reason it could be, title issue, seller issue, anything. And then just a little bit about the loan, essentially your input of the loan going into BLN. A few things that are really helpful on my end is when an operating agreement is provided up front, so we know who is going to be guaranteeing the loan, who has to based on their percentages. On a 30-year, if there's a 20% member or above, they have to guarantee the loan. And then when you're actually inputting, a guarantor into BLN, all members of that operating agreement are either listed as a guarantor or an other. The other person still needs to have their email address in there because they're going to need to e-sign the commitment letter. But when I first review a file and go into BLN, it's extremely helpful for me to have that laid out. Is just who's guaranteeing, is there another member, and then the borrower being input as the LLC that they're closing in. Just for a quick example, again, if it's a refinance and it's somebody that owns multiple entities, the current property could be held in one entity, but they want to close in a different entity. And I may not know from the documentation that I have, what they're planning on doing. So having all of that up front to me just makes my job so much easier as far as my initial doc list that goes out to my correspondents of just knowing exactly where we are, who's guaranteeing, whose credit we're using, and what entity we're using. Because my doc list is going to differ drastically when I don't have this information or when I have everything presented up front to me. And then just kind of the last part here is sensible document collection. So this is, again, something that you can kind of set expectations with the borrowers is, there's times where I'm just receiving one document at a time and it's the property management questionnaire, but I'm still missing an application and I'm still missing the ACH form. If they're going to take the time to fill out one of those forms, they should be filling out the other two as well. Only going to take them 10 minutes to do all three of those forms together. So just trying to get as much as you can, either upfront or after that document list, goes a long way. It's tough when, files are kind of piecemealed and they're just, forwarded emails to myself. And that's an email every, 10 minutes with a different document. So if you know that the borrower is going to be sending in docs, just kind of hold them for, half an hour until they've sent you everything, and then get everything to us in one shot. It just makes our job from a processing standpoint much easier, where I'm not, either using my email or going into BLN multiple times to extract documents out.
All right, appreciate that, Jay. We do have a couple of questions, so I want to run these by you as well. If the borrower is retired, do you still only count 50% of the retirement assets?
Yes, we're only counting 50% of what that balance is.
Right. It would have to be transferred into a regular bank account to count the full amount, right?
Yep, liquidated, and then we'll count the 100% if that's what they need to do.
Okay. And what about personal stocks and like portfolios like that? How would that be handled as far as counting those assets?
They count as 100%. So like anybody that has a Robinhood account, we're going to count 100% of whatever that bottom line number is.
Excellent. And the same thing goes for like a money market account, something like that, right?
Yep.
Okay. Okay, let's see here. These are, what about cash value of a life insurance policy? I believe that's also 50%, right?
Yeah, that's 50%. I just had that come up as well.
Okay. There's also a question there about some of our standard documents being uploaded into a document section of BLN. Yes, that will be coming. There's some programming that's going along with that. That's also going to be a kind of a document library where you guys will be able to kind of pluck out the most up-to-date size or the most up-to-date guidelines that'll go out and kind of those standard document forms and things like that. So that is on the programming list. That's a great question as well. Let's see if we have any more here. Do you have a naming convention that you would prefer on files, Jay? That's a great question.
For like the actual documents that are being sent in and labeled, I mean, if they're labeled, that's in a perfect world, that's what I would ask for. It doesn't happen with everybody that I work with, and that's okay. Obviously, I'm going into them anyways and reviewing them. But yeah, absolutely labeling them, it goes a long way. The extra 5 minutes, I'll just say that you guys put in on your end, doing a little bit due diligence, making it easier for us. It definitely goes a long way.
Yeah. So it would be like, operating agreement for ABC Capital or something like that.
Just laying it all out. And
yeah, that'd be the easiest way. And it makes it easier too when you kind of get that email back saying, hey, I've got these documents for you. And you can kind of see, okay, this is what I asked for. This is what I'm getting. I should have a match for all my conditions here.
for sure. And, you know, I don't think, you know, as a processor, my expectation is not that, it's not that docs are going to be 100% accurate, 100% perfect every time. But it's just some of the little, you know, obvious things that, that go a long way to me if they're always correct. So if I'm constantly getting operating agreements that, you know, are not signed or don't have percentage of ownership, but there's multiple members, that's what we really want to cut back on as much as we can. We're all realistic. Everybody misses something at some time, but just cutting down on those little mistakes. And like I talked about on the HOI with, you know, the mortgagee clause being accurate of what we asked for, just making sure like those are documents that ideally I would not like to see. But again, there's going to be corrections needed at all times, and not expecting 100% perfection by any stretch.
Yeah, but the effort is always appreciated, right?
Absolutely, 100%.
Absolutely. All right, I think that does it for some of the questions here. Let me just clear this out. When a document is uploaded through BLN, is there a way to attach a note? Oh, that's a good question. When a document is uploaded through BLN, is there a way to attach a note if there is some additional or explanation that needs to be provided for that document?
No, I don't believe there is. What I prefer, and I think other processors would agree. So if you're uploading docs, maybe just shooting a quick email as well, just saying, hey, uploaded X, Y, and Z. I know that I get quite a few BLN system generated emails in a day. So there's times that I could miss it where somebody uploads something. And I would also say, as far as, you know, document collection or uploading, is you just stay consistent in whatever you do. You know, have that conversation with your processor, whether you're going to, you know, upload docs to share file, stay consistent with that. If you're going to upload to BLN, stay consistent with that. Or if you're just going to send directly in PDFs through email, just try to stay as consistent as possible. The correspondents that, you know, I work closely with, they do a good job of staying consistent, where, you know, each of them does it differently, but I know with each and every one of them where the docs are going to be going and what I should be looking for on their files.
All right. Thank you, Jay, for your time. We're gonna Jay will stay on the call for you know, any questions that might pop up as well. But want to spend a minute too on the underwriting guidelines that went out for you guys earlier this week. And again, these are available for any of our correspondent lending partners. If you don't have these, please reach out. We'll be happy to, let me zoom out just a touch so you can see it a little better. We'll be happy to send those out. Your loan officer has a folder for these guidelines for each of the products. Couple of things to note. We've got some abbreviations on there. So the residential transition loans, these are our bridge loans. You'll notice those are labeled as RTL for residential transition loan. We also have the LTR. This is the long-term rental loan, and the GUC. That's the ground-up construction product. So feel free to share these with your team members. Give them copies as well, so that they're aware of the information. So that, you know, when you're talking to your customers, you'll have a good idea and have a reference point to look up certain items that might come up on a file, like, you know, how many years removed from a bankruptcy does somebody need to be in order to qualify for a loan, or what's the minimum credit score on this particular product, those sort of things. So I want to touch on a couple of these highlights here as we go through, and we will kind of point out, you know, maybe some of the better practices that you guys can use for your team and employees to better serve your clients. And again, keep these documents confidential. These should stay within your company. They shouldn't be distributed widely. The initial kind of disclaimer here at the front end, again, about just, you know, keeping the documents to yourselves as needed. Your first real page of the guidelines here on the RTL section is going to cover, you know, really the pricing matrix and where the adjustments are going to come in on. It's good to have just as a reference point if you're getting generic questions. This is a pretty handy thing to have open during the course of your business. That being said, all of this is automatically calculated for you within the loan sizer or the online calculator if that's how you choose to do business. So if you do have a specific deal that you're pricing out, maybe you're not understanding why you're getting a lower than what you expected LTV. The answer might be within these leverage adjustment columns. And I'll take a minute to just kind of peruse this for you, but the first section of this is going to be based on credit score and whether or not a person is a foreign national. So the lower the score, you'll see some LTV reductions for that. For higher scores, you can actually get a increase to your loan to value. The origination fees on any particular loan, if the loan is greater than $100,000, are really limited to 5% of the total loan amount. So between the RCN and the correspondent lender, those total points should not exceed 5 on any given loan if it's over $100,000. For loans under $100,000, that won't be the same problem. And again, this applies to the residential transition loan. Our 30-year product's a little bit different, right? Borrowers can buy down that rate as many as 4 points. We understand that they're actually buying something for those extra points, and those are situations that we do allow the total points to go above 5. That said, you don't want to see that they're paying a 4-point buy down and there's an additional 6 points going to brokers and correspondent lenders. Everything still has to be within reason, and the reason behind that is, historically speaking, you will see that the loans where somebody's paying a heck of a lot of points on it are the ones that tend to go bad. So there's a reason somebody was willing to pay the points more often than not. They had no intention of maybe repaying that back. So be leery of that, especially if you have brokers who might be looking to charge a lot of points. Let them know that we may come to a situation where we can't charge a certain amount of points on a deal if it kind of outweighs the expectation of what a normal pricing scenario would be. Zip codes that have declining home prices will be negative impacts on loan to value. I don't think we're going to see this too often in the current market. As everybody knows, demand is exceptionally high right now, so home prices have been driven up. That plus the inflationary policy of the Fed will continue to drive prices a little bit higher. One of the ones that you might see pop up, properties located in urbanized sections of New York, New Jersey, and California. This was really a COVID kind of policy that was put in place as people were kind of fleeing the cities, so to speak, during COVID. This one we're pretty flexible on. So if you are getting an LTV adjustment for this, talk to your loan officer about it. Odds are this can be waived if need be. And odds are we'll be able to get that full LTV for you. The better the person's qualifications, the more likely we are to be able to get that approval for you. Loan amounts where the loan size is greater than 1.5 million, typically you'll see a 5% LTV reduction there from our max terms. For the property value, if the after repair value of our property, or in some cases if it's already been rehabbed, if the current value is more than 2 to 3 times greater than the median home value for the market that it's in, you will see an LTV adjustment for that. This is the one that usually pops up on the sizer and people aren't sure why they're getting a lower than normal expected LTV. This might be the reason. And it doesn't mean that we're stuck with those terms, though. We can always raise that up with our team internally. If we can demonstrate that there are certainly plenty of homes in this individual market that are going to sell at that price point, odds are we're going to be able to get that value adjustment waived, and we can go back to our regular pricing. Or maybe if you're in the 10% category, maybe we only have to cut it 5%. So in these kind of areas, this is where we got some wiggle room. So certainly bring those to your loan officer if that happens to pop up. We want to make sure that we're always making the best possible offer to any particular client that we can, but we also are leery of making sure we don't overpromise and underdeliver. Always want to price things out in the sizer first and let people know when they're kind of giving you some generic information about it. We've all been there. People will tell you one thing and then you start getting the documents in and you're finding out, well, maybe they're not as qualified as they said they were, and things might have to change there. So but that's a good area to kind of highlight with some of your employees as reasons why you might not be seeing the max terms that you expected. And the chart on the left here will show you kind of like where those baseline terms are. But given the scenario, that pops up and you thought you were going to get, 75% of purchase or 90% of purchase, whatever it might be, and the sizer is giving you a number back that seems lower than that, come to this LTV adjustment section. This is going to be where you're going to find out what's impacting your loan and why. If it's credit based, that's probably not something that you're going to see some movement on. But for some of the market value based ones, that's an area where there's going to be some wiggle room for you. The next page is basically the exact same thing, but this is going to be for your 5+ multifamily apartment buildings and mixed use properties on the bridge loan. These are getting to be a little bit more popular. I would say that we're getting these a little bit more frequently from our investors, and we're seeing more of these come through the pipeline. So it's probably not a product that everybody out there is selling a ton of, but these can be good opportunities for correspondent lenders as well, due to the large size of the loans typically. One thing I would point out for the multifamily and mixed use properties is to keep an eye on what the purchase price or as is value they're giving you on the property for is going to be for. Our minimum initial advance on those loans, the amount we're going to disperse at closing, has to be at least $250,000. So if you got somebody who's buying one of these, say a 5-unit, and they're only going to buy it for $275,000, we're not going to be able to hit that minimum $250,000 initial advance. So that's probably an area where we're not going to be able to get it done. The other side of that I want to highlight for people is the value per unit. If we have when there's rehab, this is going to be based on the completed value of the property. But what we're looking for there is ideally something in most markets that's going to be $50,000 or more per unit. There are some markets where there's a higher threshold, and that'll be at the back of the guidelines as well. But your best bet as far as opportunity to move forward is going to be that $50,000 per door price point. Lower than that can still be done. As you can see here, $35,000 with a 5% LTV adjustment is okay. But we're still going to be looking at the market conditions, the neighborhood, and the viability of that market. We're also going to be looking at vacancy rates in those markets. And there's going to just be more data points that we're going to consider and look at when we're talking about multifamily and mixed use properties. These are more difficult properties to manage and deal with for the investor themselves. And the loan process on those is also more cumbersome and more involved than it is on, say, a 1 to 4 family fix and flip. And as we know, there's different, code and requirements from the cities and towns on these properties as well that you generally don't have to deal with on a single family property. So these ones are going to get a little bit more care and oversight. The best thing we can do when it comes to the long-term multi or even a short-term multifamily loan like this is to have that template that we have for multifamily and ground-up construction loans filled out. If we get that filled out completely and sent over, that's something that we can turn around with our team and get an approval within 24 hours on. If we're not getting all that information up front, you can expect to go back and forth for a couple of days. It's going to be a more painful process. I would say to you and your team, really stress the emphasis of getting that template completed and filled out. I believe we covered that on our last training session here in April, but I want to keep that highlighted for you guys so that you guys have the best process so that you can move files quickly and efficiently to the loan officer on your side. We can kick that up to our Treasury department and get that pre-approved within 24 hours. Couple of different things to highlight here if you guys aren't already familiar. Experience for clients and what we count for experience when it comes to the residential transition loans or bridge loans, if you will. This will play a factor in the pricing that they receive as well as the LTV that they're going to qualify for. So if we can get this kind of sorted out before we're ordering an appraisal and we can lock this stuff in, that's your best case scenario. We don't want to put ourselves in a position where we're going into underwriting and we still haven't verified experience yet. All we really need on the front end is to get the property address for any properties that they're claiming as experience and what entity they own them under. Some people will have one LLC and it's really identifiable when we pull those property records ourselves to see that LLC owned it within the last 3-year period. Some people have a different LLC for every single project. That can be harder for us to track. So if when they fill out the form, they're including the name of the LLC that they owned it under, that's going to give us the best process moving forward, so that we don't have to go back and forth and try to guess at what their actual qualified experience is going to be. For any multifamily or mixed use property, I would stress the importance of knowing exactly how much experience they have, specifically within multifamily or mixed use properties, or just commercial properties in general. That's going to go a long way towards us getting more comfortable with those investors. It can be difficult for us to look at a true first time investor who wants to buy a multifamily property. It gives us a little bit of unease because, like we said, those are more difficult properties to handle and manage and get through that process. That's not really the first project you want to have as a learning experience necessarily either. So doesn't mean they can't be done, but we're going to be really strict about the due diligence when you have a lighter experienced person trying to do their first commercial deal. A couple other things that you might see on a sizer that you're not sure why sometimes. So sometimes you might put in a fix and flip loan into the sizer that has only a small rehab budget, and you might get like 75% of the purchase price and 100% of the rehab instead of 85 or 90%. And you might be wondering why. The reason might be that the rehab budget is less than 5% of the as-is value or purchase price. If the rehab budget is only 5% or less of the as-is value or purchase price, we're going to view that as more of a stabilized property than a value add situation. For 5% of the purchase price, you're probably not going to have a high upside on the return on investment for that minimal rehab that they're putting in there. Less than 5% to us usually indicates that this is just a touch-up job or something very cosmetic. That's not going to add a lot of value, and so it's not really reasonable for us to expect to see a high-end return on something like that. If you have a borrower though who's like really close and on that borderline, one of the things you can do is tell them to see if there's anything that they might be able to put into their rehab budget that they were excluding before. That will then get you over that 5% threshold and give you the opportunity to do the loan as a light rehab, where then now you're back at those 85, 90% of purchase options with 100% of the rehab funded. Another area to kind of commit to memory or impart on your team is what qualifies as a heavy rehab. And these are the scenarios where we're going to be looking at possibly ordering feasibility studies as well. But these are areas where the rehab budget is greater than 100% of the purchase price or as is value. We're doing any kind of conversion project, right? Whether that be a condo conversion or a single family that's going to turn into a duplex, a 4-family that might turn into a 3-family, whatever it might be. Any kind of change in use or conversion will also trigger a heavy rehab. Heavy rehabs are going to get lower loan to value, and they're going to require that feasibility study. I would say, unless they're right on the borderline of one of these issues where we can maybe, get it under the wire, I wouldn't try to circumvent the feasibility study if you can help it. Oftentimes, we'll see a heavy rehab project, and if the purchase price is 150,000 and then we're going to see the rehab budget's 149,999, and we're just trying to avoid hitting that threshold. Underwriting is not going to like to see that. We're going to want to make sure that we're really being honest and legitimate about what it takes to complete this project, and you don't want to be hit with a last minute requirement for that feasibility study. Any project that involves more than 20% of the expansion of the property, but it has to be at least 750 square feet of new space. This does not count things like finishing a basement or an attic. If it's already existing space, it's not new space. They might be adding GLA, but if it's already, well, actually, basement space doesn't really count as GLA anyway, but as long as it's less than 750 square feet, we're not going to hit that trigger requirement. If it is more than 750 square feet, it absolutely will hit that heavy rehab requirement. We will need a feasibility study. There's no way around that. We will see people who might tell us one thing and then they tell the appraiser something else, as if we're not going to find out from the appraiser what their plans are. When that happens, then we're going to have to go back and tell them, yes, we now need to start the process to get a feasibility study ordered. So again, we want to order those ideally at the same time that we're ordering the appraisals. We'll have them run concurrently so that we don't have any slowdowns at the end of the process. Any kind of ground up construction project that is weather tight, meaning it's got walls, windows, and a roof, this will be something that falls under the RTL program. Ground up construction program will be true ground up construction. But if the walls, windows, and roof are up, we will consider that weather tight and still do that under the bridge loan policies. We will still need a feasibility study for those until there is a certificate of occupancy. But it does make for an easier process to go through this rather than to the ground up construction. And the last one you're going to see here is any 1 to 4 family rehab projects where the ARV is more than 3 times the as-is value of the property. This one can sometimes be waived in sensible situations, but generally speaking, if the value of the property is going to triple or more, it probably means we have some sort of heavy rehab going on. That just makes sense. So this will be a common sense area solution, but I would expect that if they really do project that high of a rate of return on their rehab, that this was going to be a situation where we're going to flag that for a feasibility study as well. You'll get some definitions in here and mins and maxes about what some of the qualifications are for these loans. I think those are pretty straightforward. You can go through there. Borrowing entities, this is a good one. People will often ask, hey, what kind of entity can I use and can I not use? So here's a list for those. Recourse loans, pretty much all of our loans are going to be full recourse. If you want to do a non-recourse option, that is possible. However, those will require RCN management approval. And we also at times might use a pledge of equity in lieu of a full recourse guarantee. You will also notice in the guidelines that they have a list of the states that we can and cannot lend on. Well, specifically the ones we can't lend on, the other ones we can. They're pretty much the same for the 30-year as well as the bridge loan, with the exception of Hawaii. Hawaii, we cannot do 30 years on, but we can do bridge loans on. This will give you the kind of term lengths here for the loans. The standard product is 24 months, but if you have a project that is really a heavy rehab and really involved, you're going to want to check with your loan officer about seeing if we can get approval for maybe an 18-month or a 24-month term on those projects. It has to be something that is necessary. We're not just going to give that to anybody, but if it makes sense, it's a larger project, that sort of thing, it's going to take a long time to turn that project around. We'll be all ears to extending that to an 18 or 24-month term. You'll have your rules here for what we're looking for gross rents as far as income properties go. Underwritten net cash flow, this would be for the multifamilies on the right-hand column here. So we're going to look at the gross rental income, any kind of expected vacancy losses, operating expenses, taxes, and insurance. DSCR calculations, you guys are familiar with the 1.1 we're looking for on most of those. Maximum loan sizes, minimum loan sizes right here for you. Minimum value requirements based on the loans themselves. Most of these, if we're close, we're going to be okay getting an approval, an exception approved there. The ones that we won't be able to is if you have a non-rehab loan and the as-is value is less than $75,000, that's a hard no. If you have a rehab loan and the after repair value is less than $75,000, that's also going to be a hard no. 75 as a completed stabilized value is going to be our absolute minimum that we can allow within the guidelines. We do allow for cross-collateralizing properties. There's usually a 120% release fee associated if somebody wanted to just pay off just one of the properties from the group. You'll have a list of acceptable collateral types here, along with the minimum property square footage that we should be looking for. This one is something to just keep an eye on. These are the Fannie Freddie rules. And the reason we have these to match Fannie and Freddie is it goes to the liquidity of the property. If you have a single family house and the square footage is only, say, 600 square feet, that property is probably not going to be eligible for that conventional financing. It makes it harder for the seller then to find a buyer to get them out of the loan. So we're going to be a little bit leery about situations where we have some extra small spaces or units. Doesn't mean we can't do it necessarily, but check with your loan officer if you see something, even if it's like 696 square feet. Check with your loan officer, make sure, let's get that pre-vetted and approved so it's not a problem down the road. Some examples of types of houses that we don't do, boarding homes or SROs, properties that have mineral leases and things like that. No log-built homes, no houseboats, no assisted living facilities, no manufactured modular or mobile homes, no co-ops, low D-class properties on mixed use and commercial properties, no properties subject to purchase options, acreage larger than 10 acres, or properties with known adverse environmental conditions beyond the lead paint, radon, and asbestos that we would see in a typical older home. Lease requirements will be listed out here for you. Minimum occupancy requirements if we have a stabilized situation and the borrower is looking to do a cash out or just a straight purchase there. This will be the guiding rules about what counts and what doesn't count. For rehab projects, we have some requirements written in here for what hard costs and soft cost caps are going to be in a given rehab scenario. So those will be good to cover and work with your team. And again, just some further information down here about what qualifies the loan as far as minimum return on investment and minimum debt yield, things like that. These are the scenarios where feasibility studies would be required and what level of feasibility study you would have to go to. The one we're looking to avoid at all costs, if we can help it, is the engineering feasibility study. These are the most expensive. You will typically see these for commercial properties, as you note over here. They're expensive. Hopefully we don't have to get into them, but that would be for a real heavy rehab on a commercial property. Property condition assessment, or PCA. Those are required on properties that have more than 2 floors, so 3 or more floors, and 10 or more units. Again, this is really going to apply to your multifamily and mixed-use properties here. Seismic and environmental studies. Environmental studies you guys have probably seen on multifamilies. Those will also apply to ground-up construction. There is a seismic study requirement for certain properties. Off the top of my head, though, I can't recall that we've ever actually ordered one of these, so I wouldn't put a whole lot of emphasis on that with your team necessarily. This will break down what your liquidity requirements are going to be for any given loan, as far as what they need to show in the bank and how that number is calculated. Jay covered a lot of this in his part of the presentation, so we can kind of skip over that. Credit and background requirements. This is where you're going to find information about how long it has to be since they've had a foreclosure. Would be 36 months. Bankruptcy, short sale, deeds in lieu of foreclosure, at least 24 months removed. Mortgage delinquencies in the last 24 months must be vetted out and approved by management. Open liens and judgments that might show up also have to be vetted out and approved by management. Credit's good for 90 days. Those kind of things. So those are good ones to check on as well. You'll have your flood and hazard insurance down here for requirements as well. Those are pretty straightforward. Appraisal requirements, these are pretty straightforward. Your loan officer is probably going to be the one dealing with that in the first place, so there's not too much you have to be worried about there. And then at the bottom, we're going to have a required kind of standard doc checklist. This isn't the end-all be-all of the doc requirements necessarily, but it's a good idea of setting expectations for your clients and knowing what you have to get into these files early and often. I know we got a few questions here. I want to see if I can jump in and answer a few of these before we run out of time. Give me 1 second. Oops. I'll make that bigger. Okay. For the loan sizer, what is the minimum information needed to get a quote? It's really what the requirements are within the loan calculator that has the absolute minimum requirements. Basically, a zip code is going to be a big one for you. You definitely want the credit score, you want the experience in there, and then you're going to need the purchase price as is value, rehab amount, the after repair value if we're doing a rehab project. If we're doing a refi of some sort, make sure we got the mortgage balance in there. But you guys can play around with the sizer yourselves a little bit. You'll be able to see that not necessarily every field has to be filled out completely. That said, if you're skipping a field that may be important, that could have an impact on the loan. So I wouldn't get too overzealous about trying to make that as shorthand as possible. But the calculator online actually has it stripped down a little bit cleaner than you would see in the loan sizer itself. Okay, let's see. There's a question here. Can we close a loan with a Canadian citizen with only Canadian credit? It's possible to close a loan with a Canadian citizen, yes. They would have to have a US-based bank account and US-based entity that we're lending to, though. We're not going to run the scenario based on Canadian credit. They're still going to get that 5% LTV reduction, but it is possible to give those folks a loan. Yes, there will be a full recording of the training. This will be added to the, if you guys aren't familiar, each one of these trainings courses gets uploaded to YouTube. There's a library there where you can actually go back and watch those other trainings. I think that's great. If you guys are hiring new employees, to go into the YouTube page and go through the different coursework that we've covered in these monthly trainings that we do. I think that's a tremendous opportunity, for new employees to get trained up and up to speed a little bit quicker. Because as you guys know, lender to lender in this space, people do different things. They have different requirements. There's different metrics that they're looking at. It's not the same as it is in the residential world where everybody's basically selling the same product. So I think that's a great way to kind of get people on your team familiarized with the updates that we have. Is the 10-year interest only loan the longest term available for the multi? Which is preferred, 5, 7, or 10 years? So for the long-term multifamily loans that we do, there is up to a 10-year interest only period, but the last 20 years of the loan are actually amortized. So it's still a 30-year term on that. You can do a shorter interest only period of 5 years if you wishes. And if the cash flow permits, you can check with your loan officer to see if we can offer a 30-year fixed rate on that multifamily mortgage. It's usually not easy to get the cash flow to work on the larger multifamilies to qualify for the 30-year fix. That's why so many of these are driven by an interest-only period up front. But if it does have exceptional cash flow, that would be the opportunity to look and ask and see if we can get a 30-year fixed rate quote on that. Good question, Rick. All right. Can we lend to a borrower that is using an LLC, which is owned by a self-directed IRA to purchase a property that needs a non-recourse loan? Great question, a question we get a lot lately for some reason. Yes, it is possible. The borrower, though, does need to be okay accepting the fact that we're going to ask them to sign a non-recourse guarantee. This is what we call a bad boy carve-out. Basically protects the lender in cases of fraud or intentional default, things like that. It is possible. Check with your loan officer. When you have one of these scenarios up front, we'll get the non-recourse option approved pretty easily. But we want to make sure we get you out the language about the non-recourse guarantee that's required. We've done a bunch of these loans. Everybody except for one person was perfectly fine with that. One person who was told up front decided it was a problem for them at the last minute and didn't close. So we want to get that information out to them early in the process, make sure that they're comfortable with it before we proceed there. Okay. For condos, it looks like there's a couple of additional documents required, and this is true. We do need the condo questionnaire from the condo complex. The HOA should be able to provide that. Unfortunately, these days they're charging an arm and a leg for those usually. That's a bit of a downer, but it is a requirement. We're going to need that to confirm that the condo is considered warrantable. Some of you guys may have run into this before or not, but the warrantability of a condo does impact our loan. For non-warrantable condos, usually you're going to see a 10% LTV reduction. But it does depend on why the condo association is considered non-warrantable. If they are being sued or something like that, that might be a situation where we can't lend on it altogether. The most common reasons we're going to see for a property being non-warrantable, though, are twofold. Either a majority of the units are owned by investors rather than owner occupants. That will make it non-warrantable. Or you will see that the one particular property owner owns a large percentage of the number of units that violates the rules for warrantability. So those are the areas where we'll probably typically see that. And you definitely want to make sure you get that master insurance policy from the condo association. The master policy covers the structure and the exterior of the unit. It does not cover the interior of the unit. So the borrower still needs an insurance policy when they are buying a condo. The typical policy we will see is called an HO6, and you can get the rent loss coverage there if you're doing a 30-year as well. The YouTube page name. Jacob, do you have that handy? We can put that out there for folks.
I don't off the top of my head, Chris, but what I'll do is make sure that that gets sent out on the email follow-up after the training.
Perfect, and we'll send that out with the link for the video too. Yes, once again on the self-directed IRAs, right? They're not providing a personal guarantee. It is called a non-recourse guarantee. So again, we will send you the language for that when you have the scenarios that will hit that requirement. But it is not a full personal guarantee. No. What's the minimum information needed for quote? Oh, we covered that one. Okay, we're a little bit over time today. I want to thank everybody for joining us. Really appreciate you guys coming back every month, doing the additional training with us. I hope you guys are finding the value in that. We get a lot of great feedback from you guys. Really appreciate the questions as well. I want to thank Jay and Jacob for their time today. Alexis behind the scenes helping us out as well. And Tiffany, our correspondent lending manager, for providing some background assistance here today. Really appreciate you guys. And if you guys have topics or information about the system, products, process, whatever it is that you guys are looking to get more information on, you'd like some further training for your team, by all means, let us know what that is. We will be happy to add that to the list of topics we're going to be covering. But I want to make sure, first and foremost, one of the big takeaways you guys should be taking away from today's presentation is making sure you guys have these sets of guidelines for your team. This will make your process a little bit easier, because we want you guys, you're the customer facing group. We need you guys to really be the first line of defense when it comes to vetting out these deals and making sure they're going to fit the requirements. We're doing everything we can to get you guys those tools, and certainly makes everybody's life a little bit easier when we, can talk intelligently about what the guidelines and requirements are up front. We don't want you guys to have to, constantly check back in with us. So hopefully these tools will be able to get you guys there to that next level. Really appreciate everybody joining us for the time today, and I hope you guys make it a great day. Thanks, guys.